Hi, everyone. We wanted to thank you for attending our business valuation webinar. We are Thaney Associates Certified Public Accountants, and today my name is Scott Wagner. I'm a CPA and CVA. CVA stands for Certified Valuation Analyst. At our firm, we have 3 CVAs. Me and Ed will be doing the presentation today. I am a tax manager and business valuation specialist at Thaney Associates. And I'm going to let Ed Thaney introduce himself right now.
Hello, everybody. I am Ed Thaney and also a valuator. We have a CPA firm here in Florida and New York. We have a total of 5 offices, and we're combined with a couple of other businesses as far as valuations of businesses. We also have a business brokerage account and business selling businesses and valuating businesses throughout the country. And glad to be here today to help you in determining values of businesses.
All right, I wanted to give you a little bit of background about our companies and what we do, and then we can get into, what's going on in the business valuation world now, how to increase your value, and how we can help you know your value right now. We have over 30 years of business valuation experience. Ed Thaney has been doing this for a long time, and part of our, portfolio of companies includes business valuation experts at Transworld. So they are also a full-service business brokerage. They specialize in business sales, franchises, mergers, and acquisitions. Another company that we also offer services related to all of this is supporting strategies. So we offer full virtual bookkeeping and accounting services along with CFO services. So basically our experience from all of these fields, we have a team of over 20 employees, many CPAs and CVAs. So we can support basically anywhere in the country. We work around the country doing deals and business valuations and CPA services. Now I'm going to give you a presentation overview just to kind of hit on the points of everything we'll be talking about today. We're going to give you a quick update, give you an idea of why it's important to know your value, identify the key value drivers of your business. These are the values that we commonly look at when we're doing a business valuation. And, the methodology is that there's 18 key value drivers. So we'll touch on the main ones. We don't have time to go over each individual one, but if you guys are curious afterwards, me and Ed are always open for a phone call. Feel free to reach out to us. We're always happy to help. The next thing is a great thing that Ed will be presenting, which will be the 4 ways to grow your business. It's a key strategy we work with a lot of our businesses on, especially when they're getting ready to sell. If you can do it about 6 months to a year out, it can really increase your sales. And we'll show you an example on how you can increase your sales by about 30%, which really increases your value as you're getting ready to sell. And then I'll show you the free discovery valuation report that we're offering for everybody. We do this as a nice way to gauge the value of your business and kind of show you where you're at today and where we think your business value could go if you help, work on those 18 key value drivers and grow and expand them. Oops. Okay, so the next slide will be kind of updating about what we're seeing right now, especially in the times of COVID. We all know that that's affecting business values greatly. But what we're actually seeing is it really depends on industry. Small businesses kind of mirror what you're seeing out in the general economy, especially, travel, entertainment, restaurants, they're all hit hard. So if you went to sell a restaurant today, the value is definitely going to be lower than it was 6 months ago. However, we are rebounding, and once a vaccine comes out, we're expecting the future cash flows and everything to return. They may not be back to where they were 6 months ago, but we're definitely expecting a rebound. One thing to keep in mind with business valuation is that the values are based on future earnings. They're not based on what it is today and what your sales are today. So we factor that in. While there is for overall risk in the total economy, we still see businesses picking back up in next year. But there are some industries that are doing really well, such as tech companies. As you can see with the NASDAQ stock prices, tech companies are doing really well. We have some of our home design companies doing very well. We also have, other types of businesses such as gun shops and cigar shops and things like that have actually taken off a lot during this economy. One thing, we want to say is now a good time to sell the business. So that kind of goes back into, it depends on the industry. Sales are down about 40% for closed deals, over the last 2 quarters, but inventory and listings are way down too. So that means pricing really hasn't gone down unless you're trying to do a fire sale. Unless you have to sell immediately, that's when the prices we're seeing go down. But if you're able to structure the deal and wait for the right buyer, there's still good deals to be had out there. And then we wanted to say, how do you take advantage of COVID to help grow your business and make it worth more when we come out of this? Expansion with loans. Interest rates are the lowest we've basically ever seen them. So if you're able to and you have good credit history, you can refinance with debt, invest in your business, set up the right fixed assets so you can grow. Refinance loans, renegotiate contracts. One thing we'll be talking about later with Ed is apply the 4 ways to grow your business. That way you're ready when the market gets hot again. Ed, do you want to add anything on this?
Yes, thanks, Scott. Just some of the issues that we have currently today. We've got, as Scott was saying, what industries are good and what are bad. Well, our flourishing clients are liquor stores right now because all the poor bars and restaurants have been closed, and they've been doing great. So the PPP money for them probably is not on the table. But then again, it's all on the debt structure of the other businesses that we've had some with the car industry, the new car industry. A lot of the requirements with the COVID had shut them down and restricted their flexibility. And what we're finding is those that have a high debt structure are having some problems right now. And even yesterday, I was trying to renegotiate for a car dealership, and it's favorable. The banks are helping them. Years ago, when this happened 10, 12 years ago, they were shutting down some lines of credits and all that. So working with the banks is good, and refinancing the debt is something that there's a lot of businesses that are burying their heads in the sand, and they should get more communicative with their financing companies and start talking about either refinancing. The SBA has been very favorable, and also, with the debt deferment that some of these banks are allowing, we're getting some extensions on that right now.
That's a good point, Ed. One thing, to really mention is if you don't have a great banking relationship, now more than ever, it's the time to start building those bonds with your bank and developing that relationship, because you want to be ready if you can refinance or if you can renegotiate contracts. You want to have the bank and have a good banking relationship so they can help you through that. All right, I'm going to go ahead and move to the next slide, and we'll be going to talk about why it's important to know your value. A lot of small business owners we work with have a number in their mind that their business is worth. They've heard a multiple from somewhere. They saw, a friend had a similar business and he sold it for X amount. And that's fine, but you don't really know the true value until you do a business valuation and bring in an expert and see, because, it's very easy to think your business is worth $1 million. But when we get down into the details and find out that you may have debt or other things, you could either easily be worth $750,000 or $1.25 million. And that's a big swing, especially when you're planning for life insurance or planning for retirement, gifting to family or friends or kids or children, exit strategies. So that's really why, you really need to know your value like a 401k balance. You should be able to check on it once a year, notice trends, look at your financial statements, look at your business plan on a yearly basis, evaluate how your business is doing, almost like a business health checkup, similar to how you see your 401k statement at the end of the year, and really check in on that business value. And we work with businesses all the time on doing yearly updates, going over strategic meetings with them, and making sure, they're really driving the value up. Ed, did you want to make any comments on that too? Oops, I think we may have a little problem with Ed there, but let me run through the common reasons for business valuation. A lot of times lately, we've definitely been seeing a lot of mergers and acquisitions going on. Specifically, customers are purchasing from the business owner. So you have a good relationship with a large customer. Typically, the customer's usually like a national brand, and you're a local business. We've seen a lot of acquisitions that way, where they're trying to expand, which really leads you at a good multiple because they have a strategic interest in buying you. We've also been seeing a lot of ESOP plans, employees buying the business, with the owners doing that. It allows a good owner buyout, and then the employees have vested interest, so the business continues to grow. Occasionally, we see IRS purposes, estate and gift taxes. A big one is succession planning, life insurance. We also see partner disputes and legal disputes, and then again, company expansion and SBA financing. All right.
Scott,
Ed, any other comments?
Scott, can you hear me? Hello,
Yes,
can you hear me now?
we got you.
Oh,
Yes, we got
good.
you back. Thank you.
All righty, thanks. Yeah, just a quick example again of what we're doing right now with some small businesses. All businesses in the $1 to $3 million range is doing succession plans, coming up with valuations, and if they have a key management person in there that they may want to sell to, or a family member, coming up with the valuation, depending on what that valuation is, coming up with a small percentage and locking these members, future people, up with a buy-sell agreement and a formula, just in case anything were to happen to the key business owner, that there's a right of first refusal to sell the company. There's a right of first refusal to exercise other rights on it, but it starts a formula of what the business is really worth. And what we're finding out when we do these valuations, that many people really do not know what their value is, and that it is probably the biggest asset that they have, which is they've only thought of it before as a stream of cash flow, but that cash flow does have a pretty significant value to it. So it's a good start even to do a small buy-sell agreement, and some of these buy-sell contracts that we've gotten into with valuations have almost immediately turned into sales because they never even thought their business was worth that much.
That's a good point, Ed, especially in the operating agreement and the buy-sell agreement. A common problem we run into is businesses aren't prepared in their operating agreement when they do go to sell. So we always recommend having us review the buy-sell agreement and this language in the operating agreement. What we'd like to do is sit down with the owners, do an initial business valuation, and then get the methodology placed in the operating and buy-sell agreement. That way, if there ever is a dispute or a quick sale, it's already been agreed upon. We can easily update the valuation for the current price, and it makes any transition much easier that way. So we definitely recommend having a review done, coming up with your valuation formulation. There's lots of different ways. We have flexibility in the buy-sell agreement. It's not like we have to file the IRS rules on that. We can work with the owners to come up with a fair valuation strategy, what's called a calculation of value, and then go from there.
And we refer to that as taking care of the sleep at night issues that many of the business owners have.
Yes, definitely. The next area we really wanted to help all of our attendees on this webinar go in is, what advice can we give you to help increase your value today and start working towards that? The methodology we commonly work with is that there's 18 key value drivers that will help a business valuation determine the value of your business, and we're going to outline those for you. We don't have time to go through each individual one today, but I did highlight the most important ones that we commonly see. I have those on this slide, and then the next couple slides we'll show you all 18 and highlight a couple more for you. The number one thing that many buyers out there look for is what's your EBITDA, what's your SDE? So earnings before interest, tax, depreciation, and amortization is EBITDA. And then SDE, almost everyone knows what EBITDA is. Most people don't really see the SDE side, which is the seller's discretionary earnings. What that really is seeing how much money flows to the owners at the end of the year, not including their salary. So you add back in your salary, you add back in your health insurance, you add back in your leased autos or any other fringe benefits you have, and you really see exactly how much money that owner is generating from that business that they could, put in their pocket, or basically what a future owner would be able to decide at their discretion to use for their business. So purchasers are always going to look for what's your business history, do you have profitability, and what are those two numbers? Because that's where the deal data we get from other sales always use the EBITDA and SDE as benchmarks. Another thing we always look for is experience management and employees. If you're coming in to buy a small business, you don't want to be solely reliant on the old owner to give you all the information and to stay around forever to help you and negotiate all the contracts. You want to have your business set up so there's key management and employees in place that know all the policies and procedures. They know how to run the business pretty much without the owner. One of the key things is, you need to be working on the business, not in the business as the owner, so other people can run it seamlessly without you. So we always look for that. Another thing is having strategic advantages over your competition. What differentiates your business in the market? Are you better at pricing? Do you have better quality? Certain expertise that others in the area don't have? We always look for that key strategic advantage, and that's usually why buyers are interested in you, especially larger buyers, like buyers on a national basis coming into local markets. They're trying to buy your expertise or your quality in that market so they can, add competition there and gain more market share for themselves. And the last thing that we run into quite a bit is not having good or reliable financial statements. A lot of times we'll run into financial statements that aren't up to date. They're not reliable. They have a lot of errors on them. They don't agree to tax returns. What we're always looking for, and what we help clients do all the time at our CPA firm, is we make sure their financial statements are easy to read. They make sense. They're error-free. We help you shore up your balance sheet, like we talked about refinancing debt and negotiating contracts. We help you get a stronger balance sheet. And then quality of earnings is a big thing too. You might hear quality of earnings out there. Quality of earnings means, the money you're earning is going to be consistent into the future, and they're not just one-time deals. Everyone looks for recurring revenue streams from customers, either on an annual basis or a weekly basis, depending on what type of business you have, monthly basis. So we really want to see strong quality of earnings, repeat business, and growing sales too. Ed, do you want to jump in on any of these comments?
No, I think you're going good on those, Scott.
Okay, great. I'm going to go to the next slides, which will go over the 18 key value drivers, and we'll jump through the key ones. These slides are available for you to download as PDFs, so if you ever want to refer back to them, or if you have any questions, our contact information is on the slides too, so reach out to us. So first ones are market drivers, and these are the 9 key market drivers for any small business. I'll read through them quickly, and then I'll highlight the 2 that are outlined there. Growth, large potential market, dominant market share, recurring revenue, barriers to entry, customer diversification, product differentiation, brand, and margin advantage. Now, why all these are very important to any small business, I think I want to highlight the quality of earnings again, just to show how important that is with the recurring revenue. You definitely want to make sure you can guarantee or almost guarantee that the new purchaser of your business, the new buyer, will have those recurring revenues, because if they can't have good assurance of that, they're not going to purchase your business. Same thing, what goes hand in hand with that recurring revenue is customer diversification. Having one large customer or 2 large customers can really hurt your value, because if something happens and that customer goes away, so do most of your sales. So we always try to recommend that no one customer is greater than 10% of your total sales. Now, we know that's not always easy for small businesses, but we work with you to try to identify other revenue streams and different product mixes that can help lower that if you have a high percentage in one customer. The next 9 are what we call operational drivers, and you can see all those on the slide. I'm going to go over the 3 main ones that we wanted to highlight, and I've touched on them a little bit already. Financial statements, that's obviously key. Without good financial statements and reliability, a buyer will be turned away. I mean, we've worked on so many deals on representing the buyers on due diligence side, where we go in and we look at financial statements, and there's so many errors. It doesn't agree with the tax return. It's an automatic red flag, and it automatically, our first thought is, we need to go in there, do more due diligence, and we almost always end up reducing the sales price. So if you're looking to sell your business at some point, we recommend buy side or sell side due diligence, so we're prepared for the buy side due diligence coming up. Another thing that most people don't think about on a small business side, and something that's gaining a lot more traction these days, is customer satisfaction. Since we're in basically an online world where everyone reviews you, one thing we're going to look at when we're doing your valuation is, what are your ratings online? How are people reviewing you? Are you easy to find your website? Is it easy to look at those things? So we also consider, we're just not all finance people. We also considering the marketing and the advertising and the growth and the structure, the management. We look at all the keys of the business. So we want to make sure your customers are satisfied. They're going out of their way to leave you reviews, and that way that shows potential buyers that you have a strong presence and satisfied customers. Another thing that we've touched on briefly before is senior management and the owner being able to easily step out of the business and the company would still run. So having key senior management there, strong employees, a long history of employment, not a lot of turnover, that's definitely helpful for buyers to see when you're selling your business. The other things down at the bottom, are important too. You want to have happy employees, human resources. We always recommend that you have a good legal team for you, or a strong lawyer you work with, that make sure your agreements are in place, your contracts are up to date, that there's no risk there with any of your customers. And one thing we always look for too is innovation. We want to make sure that you're implementing the latest technology, that you're not falling behind just because you're the only option, because that lets us believe that someone else is going to come in soon and take some of your market share. So we want to make sure you're being innovative and staying on top of all the technology in your industry, so you can keep your competitive edge. Ed, before we get into the 4 ways
one
to
other
grow your
thing
business,
I wanted to.
go for it.
Can you hear me on that, Scott? Am I okay there?
Yes.
Okay.
Yep. Go ahead and add in, Ed.
Yeah, I just wanted to add a couple of things on that. With these 18 driving points that we have, we do consulting sessions on those, and can work through. We have the tools to go through each one of those and determine where you may need help in all of these if you wanted to have what we would call the perfect book for the top valuation. When Scott was talking about the recurring revenues, sometimes that's long-term contracts are great for recurring revenues, but if you don't have the recurring revenues, we can still get to that top valuation, but upon possibly a sale of it, that's where you'll get into things like an earnout, where the buyer would say, okay, we believe you can have these revenues, but we're not going to pay you the full price unless you achieve these revenues, let's say over a 1 to 2 to 3 year period.
Perfect. So now Ed's actually going to take over and give you what we'd love to implement with all of our small businesses that we see a lot of success with them helping grow. It's really a simple strategy, but one of the key things is you got to implement it. So Ed, if you want to go over the 4 ways to grow your business, we also have an example that can really show you on the next slide just how much implementing these 4 things can really help your business. Ed, go ahead. You can go ahead and take it from here. All right. It looks like Ed we might have lost him there, so I'll go ahead and discuss these 4 ways to grow the business. The number one way to do that is increase number of customers. You can do that by adding referral systems, having a product mix, new markets, and implement sales system. The next way to do that would be to increase the number of times customers come back. We work a lot. Hey, Ed, are you there?
Hello? Yeah.
Yes.
I'm
Okay.
sorry.
Go ahead and pick up.
Yeah, I'm sorry about that. Every time we hit the non-mute button, it will block you out. So there's something wrong with this.
So I went over the increased number of customers. If you want to go ahead and jump in on the increased number of times customers come back and take it from there, that'll be perfect.
Yeah, thanks. Yeah, I could hear you fine, Scott. I just could not get in on the audible there. Yes, the increasing the type of customers, or the number of customers, and the type of customers that you want to have too. Again, as Scott, I think, did talk about the referral systems, the new markets, and implementing the sales. But the other way of increasing your business or growing your business is increasing the number of times you see those clients. Again, it's from offering different programs to them, and trying to get them back for more. I'm thinking of car dealerships and warranties and getting people in on a monthly basis. We, in our CPA firm, we do some marketing to certain niche groups with newsletters, and we do advertising and referral program, centers of influence that you have, going to them for referrals and all that. The increasing the other services that we offer would be valuations and forensic accounting. When we go into strategic planning or even valuations of businesses, we come through with some other concerns that the owners have, and we get into that. Most recently with the COVID and the SBA and the PPP, and now we're into the forgiveness portion of the loans, and hoping that Congress will pass something to maybe limit the smaller PPP loans that we're hoping to go up to $350,000 that would be possibly automatically forgiven. And same thing with estate planning and financial planning. We just don't plain do taxes, and we also, through valuations, we can again take care of some of the life issues. Increasing the average value of each sale you make, so increasing the dollar amount. If you happen to specialize in a niche market, you can go with that and increase that and see what the value is. Upselling, bundling your services into one menu of services, and then going in through the price margins. Innovation is the best. Anything you have new, we call it a unique core differentiator. And if you have something from your competition, that's a sales differentiator to make your business worth more. And then the fourth one is increasing the efficiencies of the operation. A perfect example of doing a valuation. If we did a standard valuation for you right now, we would ask for 3 years of financial statements, 3 years of tax returns, and maybe your general journal. If you could now imagine a business giving us 3 years of tax returns, financial statements, a general journal, and a book of policies and procedures that explains every single team member you have, including the owners, of what they do on a daily, weekly, monthly, quarterly basis. The valuation of that business is exponentially more than the standard business that we just get with the financial statements and the tax returns. So it's, again, with those efficiencies and with those policies and procedures, it'll makes you on a consistent, efficient manner of running the business and your training of cross-training and all that of employees, it improves your bottom line exponentially for doing that.
One quick thing I wanted to add is, when you're talking about increasing the average value of each sale, one thing you commonly see that in, just to jog people's minds on that, is especially like when you're going through fast food lines and they say, do you want to supersize or add the extra thing? That's how they increase the value of each sale, and that can really drive profits for them. The other thing is like when you're going through like a Home Depot or Lowe's and they say, do you want to add the extended warranty? That's increasing the value of each sale, and that adds a lot of profit and really brings the sales up. So I think right now we're going to go ahead and lead into the example of how this works. So if you can do 3 of those things at 10% each, this really will show you how you can increase it by 33% in your total sales and profit. Ed, do you want to kind of walk through this example real quick? I know we're getting short on time.
Right. Well, why don't you do that, Scott? Because you can talk a lot quicker. I get off on tangents.
No problem. So yeah, in this example, we look at the 3 profit drivers. So we're going to say if you have 1,000 customers and you look to increase that by 10%. So we're increasing the number of customers by 10%. So now you'll have 1,100 customers. Next thing, one of the other 4 ways to grow your business is the number of times your customers come back to you. So we're going to see, some out of those 1,000, 1,100 customers, we want some of them to come back twice in the year. If we're able to do that, or, twice in the month, depending on your sales cycle. And then we're going to try to bundle or upsell them something that will increase the total package by 10%. And that really shows you, 10% is not the most difficult thing in the world. The key to doing all of this is sitting down, developing your business plan, and strategically implementing it. And we work with businesses on doing this all the time. So it definitely is realistic to achieve. And you can see in the example how, you start out with 1,000 times, $250 for your average sale equals 250,000. But once you get the 1,100 customers times 1.1, and your new sales price is 275, that's a 33% growth right there. So that's one thing we love to do with customers and businesses is just help them implement this strategy. And we'd be happy to help you. And I've even put that down on the bottom. The number one reason for not growing is literally failing to implement. It's kind of like the personal trainer analogy, right? Most people, won't go to the gym, but if they're paying for a personal trainer, they're going to show up and they're going to get results. So, you definitely got to implement it.
Good point, Scott. And on the previous slide, it had that what we try to do with even in the 4 ways of growing your business is help you work on the business and not in the business. And I know all of you out there in your own businesses have these ideas, and they put these strategies down, and we call it building up a wheelbarrow. And never just loading a wheelbarrow, but nobody picking it up and starting it to roll. And that's the FTI down at the bottom that we say is the number one. Everybody's got the ideas, everybody's got the visions, but they're not implementing it. So we call it FTI, failure to implement. And that's what we, as bean counters in the accounting world, we're somewhat in the consistent application of business fundamentals, but our whole philosophy is forward thinking, and the only constant should be change.
Yes, totally agree with that. So now we'll get into the good stuff. We're going to show you what we're offering to everyone that attended the valuation. Even if you know anybody that didn't attend and they have a small business, feel free to refer them. Part of what we're doing is offering a free, what we call a discovery valuation report. So we'll sit down with you for an hour, and then on the back end, we'll spend a few hours reviewing your financials, and we'll review your tax returns, and we'll actually give you a free discovery valuation report and an outline of, what ways we can help you implement those, 4 ways to grow your business, identify those key value drivers. Part of the thing we'll do is we'll actually do a questionnaire regarding those 18 business value drivers and walk through each one with you to kind of see where you're at in each process and identify the areas that will most help you grow. And the next slide is just kind of an example of what the discovery report will look. It's actually a few-page PDF, but I took a picture of the top slide. So this was a small retail company. Basically, we came up with their value base today of about 500,000, and their max value, based on what we're seeing in the market, their potential business value is about 925,000. And that doesn't include owning the building and land. That's separate from the valuation. So this is just the core business valuation. And that's where we identified the value gap of about 280,000 to 500,000, depending on which strategies we can best implement them. And then you can see in the chart, it kind of says, here's your business value. Here's the areas that we can help you grow in. By increasing these things, we can definitely help you grow. So that's something we work with companies on all the time. And even if you don't want to, start growing the business now, I think it's a great idea to get the valuation discovery report. Keep it, there. Even if you want to come back next year and say, hey, can we do this again and see where we're at? I've made some changes on my own, so I want to see that. We're happy to do that for you. We're just trying to build relationships with businesses. That way, if you do ever sell or go to sell, we can help you through the whole process. But we're happy to help you now, if that's something you're planning on doing, and really help you grow the value of your business. Leading to that, I think we're a little over time, but we're happy to take questions, so please stick around. And if we don't answer your questions now, we will follow up by email. You also have our phone numbers there. If you call, just ask for my name or Ed directly, and we'll be available for phone calls, if not today, anytime next week or in the next few weeks. Always happy to have that business valuation discussion or any of the other things with you. We also do the CFO services, the traditional CPA services. If you need help with financial statements, we're always happy to sit down for an hour, free advice, or do the free valuation for you, just to build those business connections. So, at this time, I think we can take some questions.
Hi, Scott. We've got a couple of questions coming in here, so I'm going to start reading them for you. First question is, how long does it typically take to perform a business valuation?
Okay, so that really depends on the type of valuation. Like I said, the discovery valuation we're doing for you will take a few hours to discuss and go over. But if we're doing what's called a calculation of value, where you're going to be presenting it to a potential buyer or other, using it for IRS purposes, and we're doing a calculation of value, that usually will take about a week to do. And we'll definitely get down more into the details, review your financials in detail, and do all that. If you're doing what's called a conclusion of value, which is a more formal valuation, usually used in like legal proceedings or IRS, official IRS purposes, and it's a material value, that could take anywhere from 3 to 4 weeks to perform.
Great, thanks. Before I move on to the next, sorry.
I'm sorry. Currently, we're doing some valuations for the SBA, and the SBA, they have a pretty quick version that specialized valuation. Scott, you might want to share on that, but it does take it takes a pretty good a week to get it in and get it out. Before you say anything on that, also through TransWorld, we do have some determinations of values that we can do for pretty quick, down and dirty, based on rules of thumbs and historical data that we can do too, pretty quick. But they're not the formal certified values that are required in the steps required under our certification as CPAs and CVAs.
Yeah, so it really depends on what the purpose of the valuation is, but it can be from several hours to several weeks, but we're happy to advise on that.
Great. And before I move on to the next question, I did want to let everyone know, if you do have a question and you haven't asked it yet, you can just type it into the chat box on the right side of your screen, and we'll answer it out loud for all to hear. In addition, we are going to launch a poll question asking how you heard about our webinar shortly. So once you see that launched, That'll be on the right side of your screen. We'd love to know how you heard about our webinar today. Okay, next question, Scott and Ed. How has business valuation values been affected by COVID?
Yeah, so we did touch on that briefly earlier, but unless you're trying to do a quick fire sale, we really haven't seen values decrease much. Buyers are definitely looking for deals right now, but there's a lot less inventory. People have held off on listing, so the values of businesses have stayed pretty consistent during COVID, unless you're in an affected industry like the restaurant or travel industry and you have to have an immediate sale. Overall, the general economy does have a slightly riskier outlook, which does, on a general basis, decline values a little bit, similar to where you see the stock market today from the beginning. But it's been a pretty V-shaped recovery so far. So values generally are down a little bit, but we're not expecting them, since it's future business sales is what drives value.
And I might want to add there, we've had a couple of sales that have been deferred only because of the COVID, where it involved our valuations. One specifically, I believe, is closing this week. Finally, it was supposed to close in March, and we didn't want to hurt the client where they would need another valuation. But all that SBA required was a statement from us that stated that we don't think that industry was affected by the COVID, which at this time of the year we could show by their backlog of work and all that it stood by our valuation, and they continue to do it. So other industries, if it's a daycare center, something like that, it might be affected in having to do another valuation. But now that we're hopefully through all this COVID, things are looking on the upswing.
Great. Morgan, do you want to go ahead and run that poll question, and then we'll see if any other questions come in? And everyone, feel free.
I just launched it, and we've got.
Great. And then feel free to email Ed or me directly with any other questions, and we'll be happy to answer those for you. You can also call us at any time. And we're really looking forward to working on the discovery valuation reports with you. And any other valuation questions that come up, or even traditional CPA firm questions, you have tax questions or anything like that. We work with clients across the nation. We're completely virtual if you're not in our local areas. So we are definitely happy to help with anything you guys need.
All right, so we've got a couple more questions coming in. Next question is, we are in HTE defense industry, very much a niche. Can you mention how you approach niche markets?
Yeah, so we work with very specialized markets all the time. We have resources that we subscribe to that can give us the industry specifics, even to the most narrow industries out there. In the end, valuation methodology really comes down to cash flow and projected values. We do factor in your industry a great deal, and what you're earning and your technology, specialized patents and trademarks. If you do have any of that, specialized technologies, that's when we can bring in an expert to do that if we're not an expert in that sort of technology. But we are definitely able to value just about any type of business based on the cash flow analysis, the industry research, having that discussion with the owner, really understanding the business. And like I said, we can always call in an expert in certain technological aspects if we need to really get down to the details.
I might want to also add the supporting strategies business that we own is virtual bookkeeping, but they're MBA CPAs, and if you're involved with DCAA accounting, we're doing a lot of that and coming up with valuations and a lot of strategic plans with them. So if you'd ever like to talk
we have
a
lot of experience in the government contracting industry, research and development credits, developing that type of accounting structure, and really understanding those businesses. So we are very experienced in that area.
Great. We've got a couple more questions. Next question, how much does goodwill play into a seller's valuation?
So, I mean, goodwill is basically the value that you generate from these recurring cash flows. What does your existing customer base generate for you? So it's generally a very big part of every small business. It's the majority of your valuation. A lot of small businesses don't have a huge balance sheet in terms of assets and cash and accounts receivable. So you really are getting down and valuing the goodwill of the business. Ed, do you want to add anything on that?
Yeah, as you're saying, it's the cash flow. That's that intangible asset that gives you, some people refer to as blue sky. It's done with a multiplier of the earnings. And the stronger the company is, the bigger the multiplier is. For instance, as we were saying about the improved efficiencies and the policies and procedures, and everybody set there's an easy transition of management into the business. That would increase your multiplier. If your industry average was 3 to 5 times on EBITDA multiplier to get to goodwill, that would increase that up to the 5 times. It could increase it up to the 6 times if you have extended contracts, if you have locked-in contracts, if you have employees, as Scott was talking about before, in management that have been there for over 10 years. All of those indicators add to a multiplier that increases that multiplier, which is your goodwill.
Yeah, our whole goal of working with small business clients is to take their multiple from your average range of 3 to 4 to really put you on that 5 to 6 side. And when we're saying these multiples, these are general terms. If you have a high-tech company, your multiple is going to be much higher than that. If you have a accounting firm like us, your multiple is probably going to be lower than that. Those, when we're saying 3 to 5 and 5 to 7, those are general terms. So don't think that's what we mean for you. But we're happy to look at your specific industry multiples and really see how we can grow it on your end. But yeah, goodwill in general is derived from your customer base and recurring revenues, and we can definitely help you get a good idea of that value.
If you ever look, we always say just on historical costs of where the cash flow would come from a company, when we get to an adjusted EBITDA, where we add back non-recurring items, the owner's excessive salary, excessive rents, that if you own your real estate and all that, I always say it's a good buy if it's 3 times, and it's a good sell if it's 5 times. But we just got done with one IT company that was 9 times. So the industry can also bear that market, and we always try to get the highest value depending on why we're doing that valuation.
Yes. Any more questions coming in, Morgan?
Yep. We've got 2 more. So next question is, how does equity, like more loans, draw on cash reserves due to slower business months during phases 0 through 2, affect the valuation? Balance sheet effect versus P&L effect on valuation.
Okay, to answer that is, we're going to factor in, most businesses we're seeing are increasing their loans right now, especially with the SBA, EIDL loans and the other loans out there. They're drawing on their lines of credit. So if you had to do the valuation today, that would negatively affect your valuation because you would have higher debt on your balance sheet, especially if you've already used the cash to keep the business open. However, based on the future earnings of the business and paying down that debt, we don't see that having a long-term effect unless you need to sell, in the near term, the next 6 months or next 12 months. That could potentially impact your value. But we see most businesses rebounding and the multiples rebounding based on that.
Yeah, and as I was mentioning just yesterday, where I was trying to do a workout with a bank, as Scott adhered to before in the beginning about quality of earnings, that's what the banks were trying to define now, is the quality of earnings with the PPP, without the PPP, and factoring in that many of the business I was in basically stopped for 2 months, and we're trying to show them that it is turning around into a good, positive year for them. And again, they're just analyzing this quality of earnings with the COVID, with the PPP. We're showing it all on the balance sheet. So your balance sheet, your equity is diminished, and they do look at that. But they're also seeing that it's a potential of pure increase in your paid-in capital account from hopefully the forgiveness that the government's going to allow on that PPP. The debt is going to be the debt. We don't know but that's long-term debt. If your financial statements are prepared properly, it'll look good because it's a 30-year debt.
Great. Next question, how do you structure your prices for your services?
Case-by-case situation, we can go over it and give a pretty good guesstimate. If we look at things, we've always give a complimentary session. We could learn a lot with those 18 questions, and we could tell you whatever type of services. If you look on our website and you see all our services, we basically do and can do anything for you. So we can package a deal for you, just do a one-time consulting contract for you, to do just a valuation. So it's a case by case and it's an issue by issue. And if we have a little conversation, I know that we'll come up with a couple other things you didn't even think of that you would want us to be involved with you on.
Yeah, and we're very good at, value pricing our services to meet your budget. We understand small businesses don't have huge budgets, so we can tailor our services to give you the most value for exactly what you need. Basically, what we always say is get the most bang for your buck. So that's what we specialize in doing.
We do have one more question before we run out of time. Could you please explain financial recasting?
Yeah, that's sort of what I was alluding to on the adjusted EBITDA, recasting financials in what they would be without the current owners, and if management were to be changed over to on a bigger acquisition. They would be removing the expenses that are in the books that are not needed and possibly replacing them with their add back of required management expenses. If they're putting people in there, they're putting a team in there, if they require a fee for services, if it was some kind of private equity group or something like that.
Yeah, what I've done recently on the past few valuations I've worked on, especially during the last few months with COVID, is I've actually worked on a projected financial recasting. So we'll start with your current year and say column 1, and then we'll say what do we look at for the next 12 months, and we take out those potential non-needed expenses and fringe benefits and what the other owners would portray in there. Sometimes you can remove a manager or an owner salary or certain other items. Sometimes, for example, you'll have some sort of legal expenses, but the purchase buying you may have an in-house legal department, stuff like that. Same thing, art, marketing and advertising. You might spend X amount, but they already might have that in-house. So we recast the financials to make it look what the buyer will be having. So we have a better idea of the value that they could see, because in the end, it's a negotiation, right? They don't want to pay full price and you want to sell it full price. So it's always a negotiation. So we try to forecast it for you and do a presentation that really shows them the maximum value so they're willing to pay more for your business.
Great point there, Scott. And that's on, again, that's on an acquisition. We also have some, depending on that terminology, requests from some banks or financing.
Whoops. Hey, Morgan, did we lose Ed there?
I think we might have.
Okay. So I think I just wanted to once again thank everybody. Feel free to reach out with any questions or thoughts. Our phone numbers are open. Email addresses are on the slides. And we'll probably be sending out periodic updates on the valuation market and other updates occasionally. So just look out for those. And we look forward to speaking with you all soon. Thank you.